G'day and welcome. I'm Peter Bender from Bundaberg Commercial. This week we're going to do something a little bit different. I'm going to talk about the impacts of central banks and how they interplay with commercial property and businesses. Now, before 20,000 people just swipe right because they think this is going to be a dull, boring topic, just hang on a tick. Now, I've been to university, I've studied economics, but I'm not an economist. I've studied accountancy, but I'm not an accountant. What I'm going to explain to you is from a business point of view and from commercial property point of view. So I'll make a deal for you. I'll explain it in simple terms and keep the video short, and in return you won't swipe me right to go off to watch some gaming channel up on YouTube. Okay? Fair? Alright. Now, in Australia we have a central bank called the Reserve Bank of Australia. In America it's called the Federal Reserve, and you'll find that most countries will have a particular bank which is almost like the bank for other banks. And the purpose is they lend money to the other banks at an interest rate. And that is what is called the national interest rate. Currently in Australia, I think it's about 4.75. So the central bank will lend that to the likes of the NAB, the ANZ, the Commonwealth Bank. And then the Commonwealth Bank and the NAB and ANZ and Westpac St. George will go to people like you and me and loan it out at 15% or something like that. So they can take 10 or 11% cream from the work that they have. So it's very important what the Reserve Bank does in regards to interest rate. If they rise the interest rate or raise the interest rate, then suddenly the cost of finance goes up. Now, even the dodo on the corner of the street knows that the higher the interest rate goes, the less likely you're going to be able to afford to pay your mortgage, the less likely you are to be able to buy that commercial property because finance is going to get dearer. So it's a real driver, a real hammer to be used at times to manage the economy. Now, the big challenge in life is it's not rocket science. It's more an art. They have difficulties in forecasting the future, as we all do. So there are times when we sit back and say, what were they thinking? I remember about 2 years ago, the governor at that stage said that, oh no, for the next 12 months, we're not going to rise interest rates. We're quite comfortable where we are. And then we had like 11 in a row about 2 or 3 months after that. He's now in the unemployment line, and we've replaced that governor with another one. So it's a difficult challenge to work with. So interest rates is one of the main drivers that comes through there. And the other main driver that is affected when the Reserve Bank does monetary policy is exchange rates. Now, exchange rates for countries like Australia is a huge driver for our mining industry and a large part of our GDP, what they call gross domestic product. That is the sum of everything that we make and sell, is driven by exchange rates and how much coal and iron ore we ship to China and Japan and other products that we sell overseas, both hardcore products as well as IT and computing and education, online material like that. Everything is included in that exchange rate. If you buy a product or sell a product in US dollars, you will feel it when the Reserve Bank either puts the interest rates up or puts the interest rates down. Also, you need to look at the flip side on that, in that if the Americans or Europeans or Asians will change their Reserve Bank policy, well, then it has ramifications to our exchange rate. If they drop their interest rate, it generally weakens the dollar. If they raise the interest rate, commensurately, that tends to strengthen the dollar. So that's the basic concept behind it. Now, how does the Reserve Bank or central bank sit down and decide what to do with interest rates? Well, they look at a lot of things in particular, but there's probably four main drivers, in no particular order. Employment is one. If employment is very low, then the idea is you need to stimulate the economy, and to stimulate the economy, you drop the interest rates. So when we had COVID and the whole world went into meltdown, you found every country in the world was dropping their exchange rates, dropping their interest rates to try and boost the economy and resurrect the economy, drive the economy to find different ways to create jobs, because it was really traumatic for a lot of people. And I'll put my hand up. I was one of those COVID refugees. 2 weeks after COVID started, my boss came in and said, hey, thanks for coming, Pete, but you're out the door. Irrelevant of how well I was performing at the time in that industry. So employment is one of the key drivers that the RBA looks at. Inflation is probably the big ticket item right now in Australia, and probably more so as well around internationally. The the federal government will generally have a feeling on where they want the inflation rate to be. They want a nice balance. If you have inflation, then you have growth, you have wages growth, you have buying activity. So there's lots of good stuff that comes in from inflation. If you have too much inflation, well, it actually counteracts that like a seesaw and squishes demand. Because if you suddenly find, I'll take my household mortgage for an example, in 12 months, our interest payments increased by about $1,000 a month. Oh, that slows me down a little bit. I'm taking a little bit less time when I go shopping down at local tackle world to get fishing gear, because that $1,000 is what they call cost of living pressures, and that will slow down an economy. So too high inflation does create an issue. So you've got to try and find that sweet spot where you've got an inflation rate that has growth, but not too much in regards to making everything boil over and going berserk. When inflation is too high, that's when you start to get property booms and speculation, and you'll find the exchange rates will drive all sorts of foreign exchange speculation as well as shares and equities. A whole lot of things go out of kilter, and it doesn't create a good balancing act. The economy, what people want is nice, slow, steady growth. If we can get that, we'd all be happy. Rarely happens. So these are things that they look at. We touched a little bit on what they call GDP, gross domestic product. That is also linked closely to another indicator that organisations look for, and that's productivity. So if you, let's say, were a business and you made plastic piping, you had 10 staff and you could produce 10,000 metres worth of plastic piping in a month. You suddenly got a new machine in and you were able to produce 15,000 metres worth of plastic piping in a month. Now, that is what's called a productivity improvement. Whilst you've had to pay money and probably get a loan for that equipment or machinery to produce that plastic piping, it enables you now to look at reducing the cost of it and sell more of it. Or if you're in a specific market, you may be able to hold on to that price, but just sell more of it anyway. So productivity is another key factor that the Reserve Bank looks for. And traditionally in Australia, over the last decade, 15 years, we really haven't done much to raise our productivity. Might be the Aussie way of doing things. She'll be right, mate. There's not a lot of hard drive in it. Who knows? It can be all sorts of factors. The mining industry does a lot of work on productivity, tons per day, sort of type measures what they look at. You'll find a lot of people will have performance measures in their workplace, so that's a measure of productivity. If those don't continue to increase, well, then you'll find that the economy slows down. You need to make sure that you constantly have improvement, and something around about 3 to 5% per year productivity increase is good, strong, and healthy. And that happens to be around about where the inflation figure is. I think the figure that they'd like to have is between 2 to 3 or 2 to 3.5. Right now, I think the last figure I saw was about 4%, which is down from 6%. 6% was starting to drive people pretty mad. That's when they were putting up the interest rate rises. So that's the main gears that they use to have a look at. The RBA meets 8 times a year to have a look at what they call monetary policy. That's when they decide what to do with the interest rates. And in that period, they will look at things like wages growth. So we've just had the 1st of July here, which is when we have generally our annual wage increase for workers in Australia. So that had gone up, I think, 3.75%. That's quite high, but that's mainly to factor in the point that inflation was at 6%. So we really lost as a worker 2.25%. You know, we've actually a little bit worse off than what we were this time last year, what we can buy with our dollar. Hopefully that sort of explains a little bit through there without getting you too confused. The other factors that we look at is they measure savings versus spending. If as a country we are saving a lot, That's a good thing because that means we're downplaying our debt. Once again, Australia and most Western countries, and increasingly now the Asian countries as well, not renowned for savings, much more renowned for spending. And spending will drive economy and keep an economy going. I quite often talk in cultural terms, and one of the things that I've noticed in commercial property is particular cultures have changed. It used to be that the subcontinent and Asians used to do a lot of cash buying and their families used to save a lot. Even in the last 2 years, I've seen a dramatic change in the next generation that are coming through, as in the 30-year-olds, the 40-year-olds, much more comfortable to work with debt now. And this will be an interesting concept. I know it's creating friction intergenerationally with cultures. So yeah, savings and spending, watch this space. It will continue to be a challenge that is looked at from all sorts of avenues. We also spoke about overseas. Other things that can affect exchange rates is wars. Wars is one. Epidemics, financial collapses, stock market collapses, the big readjustments, as they call them. It's like you squeeze a balloon for long enough, sooner or later it's going to bust. And that is what happens occasionally. When we had the GFC, when we had the Asian currency crisis was another one. The Black Fridays, pick version 1, 2, or 3. You don't have to go back too far to recognise some of these big changes. And Australia needs to recognise we are a tiny economy. If something shakes America and they shake by 10%, you can guarantee we're probably going to shake by 80%. It really hurts a lot for us. We are pretty much at the end of the chain. And sometimes you'll see if you shake a rope, you may shake a rope here and it vibrates that much, but down the end of the rope, it's going up 8 or 10 feet. And Australia is at the 8 or 10 feet. That's one of the downsides of being isolated and being small. But yeah, that's the way that we get to play. One of the things that we have to look at is we've spoken about what we call macro policies and micro policies, big pictures, little pictures. But then we get politics. Politics is a good thing to have involved. Yeah, sarcasm dripping there. The RBA has a mandate to have full employment, and the other one was price stability. That is what the government has told them their goal is. Now, if you think about that, how are you possibly going to have stable prices and full employment? Not going too much into it, but they are almost like two impossibilities to have. You're always going to have some unemployment. You have some people who are difficult to place into employment. Some people just don't want to be placed into employment, depending on where it is they're located and their skill sets and their emotional balance, the likes of that. And it is difficult. So it is a challenge for the RBA to work with. And that's where politics gets involved a little bit. There's a term in the last one, and I'll just read it out as I've got it written here on the side. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that outcome. That's pretty blunt for saying we are going to make sure that we get full employment and price stability. Right now, inflation's too high. We're going to increase interest rates. It's like a gentle way of letting people know. People don't like surprises, so if we know a month or two in advance that interest rates are going to rise, well then that sort of helps you plan along those lines. And that's the best that the RBA can do sometimes. My economic philosophy, to a large extent, is just leave businesses alone and they will tend to find their own path. It doesn't always work. Greed is always a big factor. It's just a bigger factor as politics is, and perhaps those two try and balance each other out. So what does this all have to do with owning a commercial property or buying or selling a business? And what does it mean for you as a viewer? Well, monetary policy directly affects prices. So if you are looking to buy or sell, you're going to be affected by monetary policy. If the inflation goes up, it usually indicates that the market is getting hot or is too hot for the comfort level of the government, and the prices are rising too hard, too fast, too high, too fast. So it's an indication that they want to drive prices down. So that's one thing for you to put in your own mix when you decide is now a good time to buy. Generally, it's always a good time to buy as long as you're selling as well, because when you pick up on one, you lose on the other. So if prices are high, you're going to pay more for buying that item, but you're going to get more when you sell that item. If prices are going down, all right, you're picking up a bargain when you're buying it, but you're going to lose some money when you sell it. So it's a real factor if you're just doing one or the other. If you're just buying or you're just selling, then you really need to have your head around these core concepts we spoke about with monetary policy. Now, if you have a rising market, one of the benefits of it is you increase your equity. And a lot of people nowadays, when they go to the bank looks at how much equity you have available. What is your asset base? If you had a property that was worth $500,000, and look, there's in southeast Queensland, the residential market grew 11% in the last quarter. Oh, that's scary. So someone would have gone from 500,000 to 550,000, 50 grand for doing nothing apart from just sitting on the beach and taking it easy. So they can go back to the bank and borrow against that, 50 grand. These are things that you need to factor into. It gives you that option to go with it. The other side, if the economy is going up, you will find that rents will be lag a little bit behind. It's not as laggy behind for residential as is commercial, because commercial will quite often have annual increases anyway, or a market review done every end of lease term. So these are factors that you need to have a look at if the economy is going up, if the economy is going down. A lot of people will tag their leases to CPI, others will put a fixed rate in, and you have winners and losers on both ways. Outgoings, insurances, rates, all those aspects are also affected by how vibrant the economy is going. So as an investor, these are the things you need to have a look at and forecast. My advice has always been to people, try to borrow as little as possible and make sure that you're not putting all your money into the purchase. Make sure you've got, if you can, keep 15 to 20% behind, because stuff happens. Interest rates rise. Like I said, my household budget, there's an extra $1,000 a month that we have to find for interest rates. So these are the things that happen. And if you've borrowed yourself to the hilt and spent all the money you have or all the cash you have, you've got no room for bad times. And one thing that's certain, every boom follows a bust, and every bust follows a boom. Now, I'll put a link into the comments on where you can find a good summary from the RBA. They generally have a one-pager at the end of each meeting, which explains why they come up with the decision they have and what they're looking at. It's a good read. It's something to have a look at. And if you need to, go through this video again, because those who really succeed well in property management and property ownership and business ownership have a solid understanding. You don't need to be an economist, but you need to understand what it means when Channel 9 News puts up, the interest rate's gone up another 0.25%. You need to be able to understand, well, how does it affect me as a business? How does it affect me as a property owner? All right, till next week, take care and God bless.